Hey, everybody. This is Noah Davidson here. We're going to be going live. Let me get my disclaimer up and a little intro, and we're going to go ahead and share that with you now. Here we rock and roll. All righty, everybody. Welcome out. We're rolling live here. Going to give it a couple seconds while we wait for folks to trickle in, but we're going to be talking about seasonality tonight. We're going to be talking about how you do your analysis, how you do a top-down approach, and we're going to be walking through and just giving you some examples of what goes into a top-down approach and incorporating seasonality into that. Now, when we're talking about seasonality, what we're talking about is how markets behave on average throughout the year. And it looks like we've got some folks trickling in here. Glad to see you all here. So we're going to be talking about, now we talked about this a little bit last night in our coaches show, and I had such a good time talking about it with y'all. I thought we'd spend some time going over it and just introducing the concepts out there to everybody out there on YouTube, so we could show them some pretty cool concepts and just bring some extra value home for you, give you some ideas of how you can use this type of analysis just to help add one more thing into your arsenal, your kind of list of tools that you use when you're going through your analysis. So we'll go ahead and pop that out here. And we'll start doing our little analysis. We'll start out with the S&P and just kind of talk about, what goes into, this type of analysis. And, we're looking at the S&P right now, and here we are, late October. And I'm sure a lot of people are kind of curious what the market's, going to be doing over the next couple of weeks and months. We certainly have a very interesting election going on right now. And so just a couple of weeks left until we all get to see what's going on there. And, who knows how quickly we'll know the outcome of that. But adding this little layer of analysis to your otherwise all your other technical analysis, adding it to your top-down approach, look to your market analysis, to your sector analysis, to your individual stock analysis. I think it's a really nice addition to what you're doing out there. And so we're going to start out here with the S&P chart. You guys see my chart of the S&P? I think you can see that, right, Adib? You guys can see that. Okay. And let's see if I can get that to play nice. My mouse is not playing super nice with me. Let's see if it'll give me that. No, it's not playing nice with me. Let me see if I can figure that out real quick. There we go. A little bit delayed response. Okay. So S&P right now, I think, is just an interesting spot. We've seen a couple of days of selling pressure. We're down into a known support resistance area. We're in that bull area below the 9-period moving average, but above that rising 20-period moving average. And we've got a couple of inside candle days. What does all this spell? Indecision. I don't think the market knows whether it's coming or going. It's looking for information. It's looking for clarity. It's looking for stimulus. The market rallied on rumors of stimulus and has kind of sold off on those hopes of stimulus being dashed a little bit. And who knows, maybe we will end up seeing some stimulus, maybe we won't. Either way, this market's just in an interesting technical spot. So let me get my little drawing tool here. Grab that and just kind of highlight, what I'm seeing on that. So those two inside candles in there, let me zoom in so you can really see those. Kind of get into that. Don't really give me any new information on the market, except for one small nuance here that I notice is the long shadows on those candles. So the market has tried to rally. You've seen it actually rise throughout the day and then sell off late in the day. And that's the same story here. It was trying to rise throughout the day and then it sold off at the end of the day. And we're just seeing that inside consolidation persist. Now, anytime I see inside consolidation, I start to anticipate that it's going to break. The question is not if it's going to break, more of a question of which way the market's going to go. And I can see if it breaks to the downside, there's a big $3,400 support zone with, a couple moving averages and a big support resistance neighborhood that can hang on to. If it's going to rally, I really want to see it up above that 9-period moving average before I consider it, bullish enough to really buy in as a swing trader. Now, as a day trader, you can do a lot of different things. But again, I think we're going to be in a little bit of a wait and see pattern here, unless we get some sort of external stimulus and or again, we gain some clarity on what's coming down the pipeline with the election. Again, the market's not necessarily political, but it doesn't like uncertainty. So the uncertainty will give the market pause and usually lead to kind of wishy-washy wait and see type responses. So what I thought we'd do is we'd go through our newsletter, talk about some of the things we're seeing there, talk about how we go through our top-down analysis, and then add a layer of seasonality to that, seasonal expectations. And what you'll discover is that the market has an edge as far as how it typically behaves this time of year. Normally, from about mid-October through December, we see bullish sentiment in the market. Now, not always. It's more one of those things where it's kind of a statistical thing where the tendency is for it to be bullish, and certain sectors perform better than others. And so I'm going to start out here by grabbing the tackle trading website and logged in. And by the way, if you're not a member yet, you might want to be. I know we got a lot of pro members here. That's usually the case. But if you're new to tackle trading and you're interested in these things, check us out. We got a 15-day free trial you can subscribe to. You can, right on the homepage, tackletrading.com, and check it out. And you can gain access to things like our newsletter. So I'm going to go start out here. We'll go to the reports and go to the newsletter. And on the newsletter, this comes out every week. We publish it every weekend, so you're ready to roll. And this is the most recent one from this week. And it's put together by Marquise Johnson, who's brilliant young analyst. We love Marquise. He's a smart guy. And every week we kind of put out, again, just things to watch. What's going on? What happened in the news last week? What to keep an eye out for this week? Always giving you some good analysis, a little write up. What to watch out for. What sectors. Here, hey, check this out. This one's giving you a little breakdown of the S&P and where we're seeing, it's heavily weighted to the technology sector, for example. Just little bits of information, always keeping you plugged in. Things to watch out for this week. Some economic data coming out. Today we had some crude inventories. Tomorrow we've got some unemployment claims, existing home sales, natural gas storage. Nothing too exciting about natural gas. And you got some flash manufacturing and flash services coming out in the PMI reports on Friday. We're in the middle of earnings season, and so that's something that's always interesting for a lot of stocks. We're seeing a lot of hits and misses, and I've seen a couple of the big fish put in some misses. And then you get a little video breakdown by Marquise, kind of telling you what we're seeing in the market, gives you our analysis, what we're looking for. Now, some of the things that we use in the newsletter that I find extremely helpful are like the AR high-low indicator, giving you a snapshot of, how many stocks are bullish, making new highs versus how many stocks are bearish, making new lows over the last, 3 months. The seasonality chart, this is what I brought you here for specifically, this is a 20-year history of the S&P 500 index and how it behaves on average over the last 20 years. This chart is literally all the data over the last 20 years averaged out over how it performed in January, how it performs in February, how it performs in March and April, so on and so forth. And there's a very obvious pattern that shows up here. And when I first started doing this analysis, many, many years ago, I started to recognize the pattern pretty quick. And I was like, oh, well, that's helpful information. And, many, many, many years ago, when I first started getting into trading and investing, I bought myself, and this is kind of dating myself a little bit, I bought myself a hard copy of the Trader's Almanac. And now it's the type of thing you look at online. But back then, it was the type of thing that they mailed to you. And it was in a spiral bound notebook, and it gave you little bits of information and stats and data and things of that nature. And I came across a little saying in the Trader's Almanac that talked about in May, sell in May and go away. And it gave a little explanation that historically summer months were light in volume and that trading activity dropped off and prices stagnated. And the reason they gave is because people, particularly those who traded and invested, took the summers off, basically, is what their explanation was. Now, in the modern era, that's not the case. People don't have to take, they can take the market with them anywhere they go, because technology and the advent of course, high-speed internet and smartphones and all that fun stuff have really changed the game. But the general pattern still kind of held true, which I found really, really interesting. And what we're seeing here is an explanation of general market analysis. So I see this pattern here where the market tends to be choppy January through about mid-March, and it's oscillates, but then come mid-March, it tends to shoot up and go pretty bullish until about May. And then May or June tends to be a month where heavy selling occurs. July is actually one of the best months for the market on the bullish side, but August and September are always a little suspect. And September, October stretch is like the worst down stretch for the market, historically speaking. And then from about October 15th forward, kind of mid-October, the market has a strong tendency to run. So if you really think about it, the best months for the market are from October clear through May, with a little stagnation in January and February, and otherwise it's trending. So again, this is a concept that I'm like, okay, that's interesting, but how useful is this? And so what that led me to do is to go back and actually start looking at the data and seeing how it performs. And a couple years back, I put together a little PowerPoint full of information and stats and data. And I haven't updated it in a couple of years, but I did have some data sets that I found are pretty interesting. So let me show you this here. This is 65 years worth of data, and this is just data I was able to pull and to get it kind of look at it. And so I have it broken down month by month. January, again, for 65 years, had an average return of plus 0.94. February averaged about 0.13. March averaged 1.10. But then we see a big jump. April, you'll notice, gives you boom. And what you'll see here is, hey, years it went up and years it went down. 39 years it went up, 26 years it went down. And you'll see it tends to lean towards up years more on average. You'll see more up years than down years. But you start to get some statistics and numbers and start to understand, oh, hey, on average, April's a pretty bullish month. Almost a 2-to-1 ratio on up years versus down years. May tends to get quiet. June doesn't do much. July starts to bump up again. August is not that impressive. September actually has a negative number. And it actually has, out of the last 65 years, again, between 1950 to 2014, had 36 down years. So September's always a little suspect. But then October starts to kick in, and then boom, November and December tear it up. And so the best 3 months are March, April, November, December are the top performers, with July kind of being a laggard. It's still in there. So some data is kind of good data. And I know you'd like some of that information, Ahmed. One of the things you could do here is I'd let you take a screenshot of that data. And again, that's just data I sourced a couple years back and pulled together and just ran some stats and just figured out how often it was bullish, how often it was bearish. Now, does any of this have predictive value in any way, shape, or form? Does any of this have predictive value? And I'll wait for a second because I know there's a lag here and kind of see what you guys say. Does it have any predictive value? Historical data, that is. And some of you probably think, well, maybe it does, maybe it doesn't. And in my experience, I don't think it has any predictive value. It has a little bit of predictive value in the fact that you could say, well, what is past is prologue. Like that's about the extent of it. You could say what is past, what's happened in the past can be an indication of a tendency or a behavior. And what I'm looking at is this an explanation of institutional behavioral patterns. So I'd say, yeah, this is slightly indicative of institutional behavioral patterns, but it doesn't have any actual predictive value. It gives you a tendency, it gives you a statistic, it gives you a number, it gives you an idea of a potential edge. But unless the market actually starts going up during those months, it's relatively useless information other than to say, yeah, on average, there's an edge. You have a small tendency, but that tendency, I think, can lead to, again, some really, I think, interesting decisions. And let me, go ahead and get rid of this real quick here and bring back up that little seasonality chart. And again, if you know that on average, the market tends to be pretty bullish March through May, and then again gets pretty bullish on average, October through December, you now have something you can say, okay, well, maybe I should be looking to get bullish in those months. And then on this newsletter, again, this is information in the newsletter every week. It just kind of updates and shows you where you're at. And then we say, okay, here we are in October. And I always look at this little graphic down here. This is one of my favorite graphics. And I pulled some of this data together, and I've seen it elsewhere. But I crunched the number for about 20 years worth of history and more recent history. I'd say in the modern era, this is data that's really occurred between 99 and present date. And we look at this where we are here in October. And these are the exchange traded funds that match the sectors. So these are the SPDR ETFs, the SPDR exchange traded funds. And the two top performing sectors for October are technology and basic materials, XLK and XLB. And then I always like to look forward and see, well, what happens in November? What happens in December? And I noticed a little pattern here. Basic materials and industrials do extremely well in November and December. And that's interesting to me. And I know that technology does well. And I actually have gone through in my research, and I went through and I found a bunch of data, and I laid them all out. And let me show you this little graphic I have here, where I have all the sectors' performance. I've got them color coded and broken down by month. And I can see, well, which are the top performers that time of year. Now combing through that chart takes some serious time. Like, you actually have to get in there and say, okay, well, hey, if I'm out here in November, December, what are the top performers? And there's that XLB, that little color right there. And sure enough, there it is. Boom. XLB is really high in November. So, that kind of data and information can be helpful. XLE, not a good performer this time of year. Financials don't do as hot. Industrials do. And so again, they tend to perform well October, take a little drop back on the industrials. They do well in November, and then they kick butt in December as well. So you kind of see a general trend there on the basic materials. Same thing when you get in the tech sector, you can see a performance, really rocks in October, still does well in November, tends to die off a little bit in December. Knowing that about the tech sector could help you know when to take profits. Again, and so you can break down the data and you can use that. Now, I took all that data and information and said, well, look, if that's interesting data, which I think it is, I think it's very interesting data. What I find helpful is to just come in and say, well, what are the best two? What are the worst two? So I'm going to avoid right now financials and utilities. And I'm going to focus on right now technology, basic materials, and industrials. And then you can use that information to go dial down and say, okay, well, right now, what are the leading sectors? And sure enough, there's technology, there's industrials, but basic materials is lagging a bit on this little scoreboard that we put out every week. And that's something we update every week. We kind of give you our current rankings on how bullish or bearish we are. And I noticed a little pattern here on this table that I think is super interesting. Take a look at XLB right here, for example. In July, XLB is pretty hot, but in August, XLB drops down to one of the worst. And in September, XLB drops down to the worst. So you actually have a downward cycle from July through September in basic materials, but then it comes roaring back October, November, December. And that's interesting to me. So, okay. Well, and I could look at, again, the XLB. I also noticed the same thing with the industrials, same type of thing here as all of a sudden the industrials come out of nowhere and become top performers here. And when I've looked at the full data, they do the same thing. They kind of get soft in July and August, just like the basic materials. And so my top three sectors that I always look for heading into that fourth quarter are basic materials, industrials, and and technology, excuse me. And I usually expect technology to die off a bit towards the end of the year, like it kind of gets weak in the second half of December. But again, that information can be somewhat helpful for you. So now we take that information and we can go say, well, okay, well, what stocks make up, basic materials? What stock make up the industrials? What stocks make up technology? And I think most people are kind of aware of the technology sector, but they might not be as well versed in like who makes up the industrials, for example. And so I pop open the industrials and I'll say, okay, who do we see up here in the industrials? Let's make sure we got that there. Let me just double check that. XLI industrials, boom. Okay, and you've got a couple of stocks you may or may not recognize. I recognize Cinta. It's got another nice little pullback. NOC, we got about 3 pages full of this stuff. General Dynamics, a couple defense contractors showing up in there. Info Systems, 3M. You might recognize a lot of these companies: John Deere, DE, Honeywell, Caterpillar, so on and so forth. Union Pacific, a couple of the railroads show up. And then this is one of the things I brought you here for: FedEx and UPS. These are ones I look for every fourth quarter, and they tend to do extremely well. Because again, I don't know if you guys know this or not, but people tend to buy a lot of stuff in the fourth quarter. And more and more people are buying things online. And again, might be silly and obvious, but it's pretty reasonable to expect FedEx and UPS to start to run. And again, remember, the market's a forward-looking instrument. So because it's a forward-looking instrument, and we can take these ideas and say, well, okay, well, right now it's October, but we know that November and December are coming. And we know that these stocks tend to perform well this time of year. This sector tends to perform well this time of year. And then I can go look at the charts. I can go, crack into my Thinkorswim platform, for example. And I can say, well, we know how the market performs. And if you have a platform like Thinkorswim, and there's some other platforms out there that can do this, they have a cool little feature in there called seasonality. You can go to your chart style, go down to your chart mode, and you can hit the seasonality button there. Boom. And it gives you 2 lines, and it gives you the current market, the blue line. It gives you this red line down here, which is all squishy and squiggly. And the trick to this is you want to make sure you got tons of data loaded up. You want to make sure you got at least 20 years of data or 10 years. Get yourself some data. And we're looking at the S&P, and you need to get your chart set to a manual so you can just highlight the red line. The blue line is just what the market's doing as of right now. That's the year to date on the market. The red line is the averaged out history. And here's that chart we were looking at earlier of how the market performs on average throughout the year. So this is the S&P. Now, remember, we were talking about basic materials and industrials. So let's take a look at the industrials real quick and do the same thing here, where we, take a look at just the seasonality, kind of highlight that, and just look at that data. Okay. And check that out. The industrials drop September, October, and then about mid-October, they start rising and they rip up through December. So that's pretty cool. That's interesting. We can do the same thing for the basic materials, XLB. Pop that in. Again, here's the data. You want to set that chart to manual. You want to highlight just the red line. And sure enough, here's that exact same thing we were talking about. August, September, October, and basic materials goes down. But then come November, December, that rips up. Pretty strong, solid move. Okay, so that becomes of interest to me. And then I can go through and I can find stocks from within the group that I find useful. So let me go back into that tackle trading page that we were just on here. Let me go back to the news report and go back into that basic materials sector. So let's go hit that basic materials. and see which kind of stocks pop up here. And again, these are the top holdings. And I can go through and see, well, what are the actual top holdings? That's not too hard to research. That's just a matter of a quick Google search, like XLB, basic materials, XLB holdings. And I'll usually pop open like the ETF report or the spider report, and you can get that, information right there. Here's the spider ETF. And you'll recognize some of these candidates like LIN, Air Products, APD, Newmont Mining, Dow Chemical. You might recognize a lot of these, Freeport McMoran, and you might recognize some of those stocks. You can go, well, with the top holding is LIN. Let me show you something super interesting here. In our reports, and I think it was in the stock report. Let me go double check it here. Might have been in the options report. I might be fishing for this one here. Santa Claus rally looking hot. Lots of data about the Santa Claus rally. And nope, it's not on the Bulls watch list here. I know we talked about it in our meeting. It may or may not have made the list, but it should be in here. I believe it might be in the options report. Let me go check that one out. And again, there's that same kind of explanation of what we're talking about with seasonality. Oh, we must have cut it. We must have cut it off the list. I know we had it on the list. It might have been on the list last week or the week before. I know we've had it on the list recently. So, and it's been one of those that we had on the report maybe a week or so ago. And rather than waste your time while I sit and find it, we can say, okay, well, if I go look at the top holding, and I do the same expectation where I go look at the chart. Okay, check that out. Boom. Well, this stock seems to have a pretty good seasonal performance over the last 20 years from October through December. Now, that doesn't mean it goes up every year, but that gives me that little piece of information. So now what I'm going to do is I'm going to switch my chart type back. I'm going to switch that back from the chart mode of seasonality to just a regular stock chart. And then usually here, what you can do is you can go load up all your historical data and go, look back in history and just get a feel for, okay, over the last 20 years, okay, we're taking a little trip back in here to 2001. And here is Lindy. Oops, let's get that right there. Boom. Let me zoom in on that a bit more. And just kind of play it out. How did it perform heading into the end of the year? And here it is, late September. This is 2001. Boom. It ripped straight up from September through December in 2001. Fast forward to 2002. October through December, bullish activity. Not as strong as 2001, but a good bullish run. 2003, fast forward, September, October, November. Boom, just straight up, just rips up. Okay. And what I'm looking for is the years that it didn't work. Like, that's what I'm trying to get a feel for. Okay. Does it work every year? Not always, but here we are in 2004, October through November. It shot up through November, and then by December it dropped. So it sold off late. So it ran October, November. Right as it hit in December, it starts dropping. So 2004 says, okay, well, maybe in December they're selling. I'll keep that in mind. Fast forward to 2005. Here comes October. Boom. It goes ripping off again through December. Okay, so pretty good. We're batting 1,000 so far. 2006, October. Boom. There it goes ripping again. Hits December and then drops again. So I know we're probably, so far, I'm seeing good evidence of October, November. December, we're more like 60% of the time, not 100% of the time. Fast forward 2007. We all know that 2007 was a rough year. 2008 was a rough year. But again, here it is, October. and it popped up to November, and then it didn't do so hot, dropped, and then finished out the year, with a little bit of weakness. So 07 didn't do so hot. So that's evidence that, it doesn't always work. Fast forward to 2008, market had a horrible year. Get to the end of the year, here comes the big meltdown in 2008. It's just getting crushed. But here it is, late October rally, and it finishes out the year just rough. Like the whole market got crushed that year. That's probably more of a testament to the broad market, but here's proof right there. It doesn't work every time. Okay, well, that's, again, so is this helpful, by the way, just kind of going through this stuff like this, just kind of breaking down? This is just how I think as a trader and kind of how I go through and just see, well, do I really have an edge if I'm leaning on that information? Fast forward to 2009, here comes October, November, December, pretty flat in 2009, didn't do a lot. 2010, here comes October, November, December, pretty bullish, nice little run. 2011, fast forward to October popped, boom, November dropped, December popped. So up October, down November, up December. Boom, fast forward to, again, 2012. This one took a little while to kick in. It started in October, dropped, and finished up the rest of the year strong. So started October, gave you a little pop, drop, came in strong. 2013, October forward, looks pretty bullish. 2014, so on and so forth. You guys get the idea, right? Like you get the idea that this is, going through the historical analysis, trying to understand the strengths and weaknesses of the thesis. And that, okay, hey, this tends to do well. October, November, December, did well in 2014, 2015. Bear market, it's getting crushed in 15. It's going down, 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 down until October, boom, and then it rallied through December. So that one went contrary to it was heading down pretty solid through July, August, September. Still finished out the year strong. Again, 16, kind of choppy, finished up October, November. It ended up higher, but it was ugly. 2017, November, December, way bullish. 2018, not so hot. 2018 had a rough fourth quarter, so it chops it down. 2019, finished up the year really strong, and then here we are, fast forward to current date. So now, this is where we are right now. We got a consolidation pattern. We got earnings coming. You got a triple bottom possibly, and this could break down. And I'm really not that interested in this stock unless I start to see some upward confirmation. But, with this setup right here, if I were to back it out to a weekly chart and kind of look at it from this perspective, you got a good rally and a pullback into a known support resistance zone. Looks like it's violating the 20-week average. So that's showing some signs of weakness. And with that earnings announcement coming up here on the 5th, it looks like I might want to hold off and wait until I see what happens on earnings before I go plan and place a trade on it. But at this point in time, it's got a lot of the conditions I want to see. I know I've got the history, the track record. I know I've got the possible double bottom at support. I know it's still trading inside, but I don't have upward confirmation, and I'd be a little cautious heading into earnings. So, earnings is always something that factors in. And if you're a gambler, you might go ahead and buy into that. There's probably different ways to approach it. I maybe at a minimum would go in and do something like sell a credit spread or some higher probability, like a naked put, way out of the money, and see if I can bring in some cash flow. But then I go from there. I can go, okay, well, what's another stock on that list? And I can go back and I can do the research. And again, I won't make you go through all that again, but that's literally how I've come up with over the years, my seasonal expectations. And anytime I find a new stock that I'm interested in, I'm going to go through the same history. I'm going to go through the data, try to figure it out, kind of get an idea. And again, it's not that the past has any predictive value, but what I do think it does for us, Ahmed, is I think it gives us an insight into institutional behavioral patterns. And those institutional behavioral patterns are things that we can use to just give us, again, an insight into how they have behaved in the past. And I'm going to be looking for signs of that behavior right now. And this is one of the things I love to look for right now. This is actually a good example of it. Is, got a drop, it rallies, got a drop, and then that slowdown, that whole consolidation pattern in there, that slowing momentum, again, doesn't guarantee it's going to take off. But if I start to see it rising back up, and I probably want to see a confirmation above 240 here. And that may not happen right straight away for two reasons. One, I think the market's going to hesitate heading into the election. I think we're going to see a lot of indecision over the next couple of weeks. We're like less than 2 weeks till the election. And then this one's earnings come out right after that. So this, a little bit of wait and see. It may pick a direction sooner than that. It may have a good or bad earnings report. I could always go kind of get a good feel for, what the forecasts are and their earnings announcement. I might take a small speculative trade or do something, maybe speculate with one of those Geno butterflies or something that doesn't cost a lot. That's pretty cheap to speculate with. But it gives you just a basic idea of like, okay, I've got a context here and something to keep an eye on. That's going to go on a watch list for me. So on a watch list, and that's it. At this point in time, that's all I get out of this. Now, one of my favorite go-to every year, I'm trying to figure out how to wrap my tongue around that. My favorite go-to plays every year. Every year I'm looking at the stocks like FedEx and UPS. And I like to look at the big box retailers like the Targets, the Walmarts, the Costcos, and see how they perform. And again, same kind of thing. It's not too hard to imagine that Walmart performs well in the fourth quarter. And so I can go switch my chart back to the chart mode, go check out the seasonality on it, and then get a good feel for how does this thing perform over the last 20 years. And I got to reset that so I missed the zoom. Try that one more time. Okay. And I notice a pattern here on Walmart that I think is very interesting. It rips October through November, but in December it drops. Okay. Well, that's interesting. Rips through October, November, but December tends to drop. That's statistical average. And I can go back and study the chart just the way we did a minute ago. Let me switch that back to the standard chart mode and go take a look at the chart of Walmart. And, here, check this out. This is exactly what I'm talking about. Big, beautiful double bottom, W pattern, October. Catch the breakout. Boom. Catch the retracement. Boom. Inside consolidation on a rising 9-period moving average. Guaranteed, not a guarantee, but I'd feel pretty comfortable, with this if you're not already in a stock like that. And again, the idea is like, that's exactly what I'm looking for in a September, October scenario. I know September can be rough. I love the slowing momentum bottom. I love the old support resistance neighborhood, the double bottom W pattern, and the breakout. Boom. Pretty cool, right? Now, if you're looking at an inside consolidation like that right there, and I mentioned this earlier, what happens when you get a couple of inside consolidation candles? What happens when you see inside consolidation on average? And I know you guys know the answer to this because I gave it to you earlier when we were just starting out talking about the S&P. Inside consolidation leads to breakouts. The trick is which way. Sometimes it breaks up, sometimes it breaks down. I'd say with the trend, most of the time it breaks with the trend. So it'd be reasonable to expect a little inside consolidation like that, a little inside day to turn into a possible breakout. And I'd have a target of 150, no problem. With a little bit of luck, you might see it rising out towards 155. You might see a nice little appreciation. But expect it to run through. They don't have earnings until later in November, and then I know that by December, I kind of expect that end to come to an end by December there. So something to keep in mind. Again, I can do the same thing on the Costco's of the world. Costco's recently ripped up and shot through the roof, but same type of thing. I normally expect it to start to run in October. Here's the sell off. Boom, boom. And kind of a double bottom, inverted head and shoulders, breakout. Boom. There's no reason you couldn't be long that heading into October, catching that run. Here's your inside consolidation again on the rising 9. That little inside consolidation oftentimes will lead to a continuation. Even if it drops, I'd still want to pick it up on a buy. And so again, there's no guarantees that they have a rock star year, but their post earnings, they've already given us forecast and guidance. I don't have to worry about earnings again until December 10th. And they do pay a dividend. So this one, hey, maybe even owning the stock's not a bad idea. And hopefully this makes sense where you just, I'm just looking at how people behave in the market. And there's another little piece of information I think you might find helpful. And this is an overgeneralization, but and this is a concept, that I again was just thinking through a long time ago. Had one of my mentors explain to me. He's like, the market does have a general business cycle. Okay, general business cycle. And usually what it looks like is in the first quarter, we have basic materials perform well, agricultural stocks pick up strong. And there's a reason for that. Spring planting season starts kicking in around April, and agricultural companies sell almost all their stuff in that first quarter. If you're a farmer buying your seed, buying your fertilizer, buying all of those chemicals like Dow Chemical puts out, et cetera, they're going to be picking those up, getting ready for the spring planting. And so agriculture tends to do well. Basic materials tend to do well because we buy the stuff, and then in the second quarter, manufacturing picks up. We tend to expect manufacturers to perform well. You'll see, I usually see energy and oil, coal tend to do really, really well heading into summer. Industrials and utilities tend to do better. And then, so we buy the stuff to make the stuff, and then we tend to ship the stuff to market, transportation, railroads, trucking. And in the fourth quarter, we already know about the industrials and the basic materials performing well, but retail does well. Tech sector does well. Stocks like FedEx, UPS, tech sector, the broad market does well. And again, you'd add into that, basic materials and industrials tend to do pretty well in that fourth quarter. But it's just that simple stuff. We buy the stuff so we can make the stuff. We ship the stuff to market. And we consume the most in the fourth quarter. So once you get that, your kind of head wrapped around that general business cycle, and you start thinking about, how does each sector perform, and you get a good feel for, top performers, bottom performers, month over month. Let me go, and the one on the stock report, the newsletter is up to date there. Let me go capture that newsletter there one more time. Q1. Yeah, it's three months, right? Q1, Q2, Q3, and Q4. So, every 3 months, and we just finished the third quarter, heading into the fourth quarter. And it's usually on April 15th, October 15th, the tax days coincide with it. It's right in there. So back to this again, one of my favorite little graphics right here, this little guy, seasonality. Again, if I know what to expect, from technology, basic materials, industrials, and kind of keep that in my mind, and then again, go down and find the stocks from within those groups and say, okay, what other, let's go hit that tech sector and look at the top. And we already know these stocks, we already know a lot of these stocks like, Texas Instruments, we got Visa for whatever reason gets put into tech. You're going to see, your stocks like Apple, of course, and things that'll come into the tech sector. And there's tons of candidates in there. Again, we can filter through, find them, PayPal, Oracle, NVIDIA, NetApp, Micron, Microsoft, Microchip, so on and so forth. And I can start looking for, good patterns and setups. And so I kind of run through those, and I'm looking for, well, who's got a good breakout? Oh, PayPal's breaking out right now. Okay, that's interesting. Guaranteed, not a guarantee, but who doesn't love a new breakout? Now we do have earnings coming out here, so watch out for that. But boom, check out, little cup and handle. So I got, strength of sector, strength of market, strength of trend. This one's breaking out, actually making a decision. It's ahead of earnings, so you'd have to watch out for that. And there are ways to trade around earnings, more safely than others, but that's the general idea. Hey, find a candidate, go about planning a trade. Now, for the pro members in here, I know we got a bunch of pro members here. In a few minutes, we're going to be doing the step system. We're going to be talking about swing trading, and these are going to be where I pull my candidates from, is going through and finding some candidates. And we're going to talk about how to go about swing trading these with stocks, swing trading with options, and kind of break down some of the things we can do with the swing trade, what we can do for a position trade. But this is the precursor to that. I'm just kind of going with the live scenario here, just giving you an idea of how you go through. And again, I'm doing a top-down approach. I'm adding in a seasonality aspect. You can, of course, incorporate all your fundamental analysis. And then I'm looking for industry leaders and things of that nature. Maybe companies that have new products coming out heading into the fourth quarter, or somebody that's got a lot of utility, like a PayPal heading into the fourth quarter. I know that their volume tends to pick up because, again, more money starts changing hands in Q4. Again, with a little bit of uncertainty in the next couple of weeks, it'll be interesting to see how it all plays out. But I think it's good to be raring to go and to be ready for. And I think the market's going to be looking mostly for stimulus. And, we're kind of in this weird market right now where I think the idea of value investing, value buying is tough because stocks are so highly valued. A lot of things are overvalued. And I think we just know that going in. And the stimulus machine that seems to be turned on, and they're going to keep it turned on. We know the feds are going to behave the way that they behave. And I believe that we're going to see some sort of government stimulus in the next couple of weeks. And again, regardless of, which candidate winds up in the White House, well, again, I don't think the market really cares as much. The market cares about policy. It cares about taxation. It cares about, policy as far as like what's trade policy, what kind of regulations are going into it. I know that the market prefers fewer regulations, and I think they love that stimulus from the printing machine. And so, I suspect we're going to see the Feds keeping rates low, and they're going to keep the stimulus coming at some point or other. And at some point in time, maybe it all comes to a crashing end, and we see a big correction in the market. And at which point in time, that's where all of our risk management tools come in. But hopefully, this has been an interesting and engaging little conversation for you. And what I thought we'd do here, just a little different. Again, we got a good little group here. Would it be okay if we just opened it up to Q&A for the last 10 minutes? And again, there's a little lag between me and you, probably a minute lag, somewhere in that ballpark, maybe 30 seconds. But if you guys have questions, start typing fast and furious, and I would be happy. Policies, government policies. Okay. The market, I believe, is apolitical. It doesn't care if you're a Republican or a Democrat, if you're a Trump or a Biden, it doesn't matter. The market's going to care about tax policy. Congress can control taxing and spending. If we were to see a huge increase in taxation, that could throttle some growth. Now, there's pros and cons and benefits to higher rates of taxes. You might see corporate taxes go up. It may not affect your average consumer. So we just have to look at the policy, and then you have to extrapolate that out forward. Well, how is this going to affect people's behavior in the long run? Regulations, for example. If you have, too many regulations, that can stifle economic growth. It just slows things down. And there's usually good reasons for regulations, but too many regulations or specific types of regulations that say maybe favor, for example, imagine, Ahmed, that they came out with a tax policy incentive for you to buy electric cars. You get a tax credit if you put solar panels on your property. You get tax incentives that could lead to a further boon in that industry. If you were to see that coupled with, cutting back regulations on, battery production, for example, or reducing regulations on the solar industry, couple that with a tax policy, and all of a sudden, boom, you've got a growth sector. And so, tax policies and government policies in general are usually written to kind of incentivize behavior. And so this is what I say. The market cares about policy. It doesn't care about politics at all. It doesn't do the whole cult of personality thing. doesn't get all involved about, who said this or who did that or who tweeted what. But it does care about, the legislation that they come up with, the tax policy, the spending policy. And then outside the control of the government, you got the central banks, who are a entity unto themselves. They're not federal. They're not a government agency. They report to Congress out of a courtesy. They control the money. They control interest rates, monetary supply. So what if you were to see a negative interest rate policy? We're at zero interest rates now. They're not planning on raising rates, but let's say that the printing and the low interest, zero interest policy stops being effective and they go to a negative interest rate. Well, what would that mean? Well, that means if you put your money in the bank, let's say you put $100,000 in the bank and they had a negative 1% interest rate on the US dollar, how much money would you have left in the bank at the end of the year? Well, I don't know if negative's good. It punishes savers. If you put $100,000 into a savings account at the end of the year, you'd have 99,000. Does that make sense? So if you know that you've got a negative rate, they're charging you interest on holding the money. Are you going to want to put your money in the bank? No, you wouldn't. Well, what would you rather do with your money if savings no bueno? If savings no bueno, what do people do with their money when saving is discouraged? They spend it. Well, what are they going to spend it on? Maybe they invest. Maybe it just sends stocks higher. Maybe it incentivizes people to go spend, plus they get a tax credit for electric cars. And I'm just making this stuff up off the top of my head, by the way. And all of a sudden, GM's put out a brand new electric Hummer that looks pretty cool. I might want one maybe. And all of a sudden GM stock goes through the roof, or Tesla stock goes through the roof. Yeah. So that's where I care about politics. It's not politics. I care about policy. And I'm a bit of a policy junkie, and I pay attention to trade deals and things like that. And I pay attention to who benefits. And we know if they go negative, gold's going to go well. So that's where you pay attention to your politics. Is not, what they say, because you don't want to get me started on that. It's all rhetoric. It's all propaganda. It's at the end of the day what they do, and what they do policy wise is more important. And so I think, if you get, a Trump administration, some people will love it, some people will hate it, but I think the market's going to be like, okay, low regulations, low taxes. That's what they're going to be getting. That's what they think they're going to be getting. And then of course, what they actually get will be based off of what they actually can pass through, what kinds of things they pull off. If you get a Biden administration, we're probably going to see a raise of tax rates on top earners. They say over 400,000, but what tends to happen is that's never holds true. They end up taxing the middle class as well. And so people will have to higher taxes. They might have less discretionary income, and that could curb, consumer confidence. And then again, but then you might get benefits where they put government spending into green energy. And you might see sure, they raise taxes, but then they spend the money on infrastructure builds. And so, you don't really, and I don't really know exactly what their policies are, because they haven't really done a great job of laying them out. But the idea is there that, okay, they're going to probably spend money on this. They're going to probably regulate the hell out of fossil fuels, and they'll probably then start giving you tax incentives and benefits and things to go to cleaner energy, solar, things like that. Natural gas maybe stays strong in there somewhere. But that's the idea. Is policy is designed to incentivize behavior. And you couple that with, your regular fundamental analysis, your regular sector analysis. You don't have to really predict what the market's going to do. You just have to watch their behavioral patterns and find the trend. Find me a good trend, and all I need is a good company, good trend, good sector, good breakout pattern, good trade setup, good 2-to-1 reward to risk ratio. That type of thing. Any other questions coming in? I'd be more than happy to answer those. We got a couple minutes here until the top of the hour, and then we'll have a little half-hour break. And all the pro members, I want to have you come out to our step system. swing trading webinar. We probably extrapolated out to position trading and talk stock and options, how to manage it. Don't be shy. Got a good little group here. And by the way, if you are new to us, if you're new to Tackle, give us a like, give us a subscribe, follow us. We're always putting out quality content on a daily basis. Always got something new and exciting going on. And again, free trial membership for all pro members out there. Get in, get to know us, get to know our community. We're here to help educate and inform and teach you the ideas, concepts, thinking, and skills that are going into trading and investing. We even give you awesome scattering reports and newsletters and daily content reports to keep you plugged in. Hey, I love earnings season because there's always something exciting going on. Who did I see had a really crazy interest? Let me just pop this open. Chipotle announced earnings tonight. And, Chipotle was trading up right near the all-time high. Just right up there near the all-time high, came out, had their earnings announcement. Looks like they actually had a beat. But overnight, I saw that their prices shot down, then shot back up, and they're back down. They're probably going to open tomorrow somewhere around that 1,300 mark. And that'll be interesting to see. But that's always fun. Snap was big today. Snap really popped up. Good positive earnings. That sent a few others through the roof here. Boom. After hours, shot up, opened, ran up, came back down. So you look at that on the daily chart. Big green candle. Big breakout pop. Does that create an opportunity for you to trade? Maybe. You might see a gap fill. You might see it run. That's a pretty darn big gap. From 30 to 30, so that's 6% pop. Bam. Nice. BIIB had earnings. You guys are all over that. And BIIB had their little announcement. Boom. Well, it looks like they had a beat. And after hours thus far, pretty quiet. Not a lot of after hours trading on that. So we'll have to see how that one trades at the open. All righty, guys, we are up against the top of the hour. And again, as always, we love you. We appreciate you. Come out and hang out with us. If you're new to tackle trading, you want to go, get that pro membership, sign up. Let me get you back to that. Where I took it all the way off. TackleTrading.com, main page, right at the bottom. 15-day free trial, always there. Come check us out. 15-day free trial. And I've had a good time with you guys tonight. Appreciate y'all coming out. See all your pro members.